Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include some news emanating from Washington when it comes to FEMA and the CFPB at least. My interview with Finance of America's Adam Potafiy on his session tomorrow at NAMB National with his colleagues Jonathan and Jessica about reverse mortgages and how they're being reengineered for the next generation of clients. And I actually have a bonus interview for you with attorney Brian Levy talking about some RESPA cases currently in the news as it pertains to UWM. And in the capital markets, the longer the government shutdown lasts, the more impact it will likely have on overall economic output and GDP. Today's podcast is brought to you by Potafiy, an industry-leading point-of-sale platform. With Potafy's new dynamic AI feature, lenders can modify applications with no coding required and rely on AI to autofill key application fields, allowing borrowers to fill out only a few fields relevant to their needs. The result? Faster completions, fewer drop-offs, and smoother approvals. Discover smarter lending at Potafiy.com or visit Potafiy in person at MBA Annual. Under the category of careers that are or will be impacted by artificial intelligence, attorneys are inevitably on it. There's a tale of a lawyer caught using AI while explaining to the court why he used AI. Look it up. In other legal mortgage news, California mandated forbearances for mortgage borrowers affected by wildfires. Meanwhile, is disaster assistance based on politics? Apparently, California is not receiving any disaster assistance from the federal government from the fires 9 months ago, and the city of Los Angeles joined a coalition of cities, counties, and local agencies in a lawsuit against the Trump administration over FEMA funding. Under the category of the minimalization of Congress, White House Budget Director Russell Vogt said that he wants to close the U.S. Consumer Financial Protection Bureau, even though President Donald Trump's administration has argued in court that there's no such plan. This is despite the Trump administration's claims in court that the agency is just being downsized. Meanwhile, law firm WBK reports that the CFPB recently announced that it's restoring the confidentiality of supervisory designation proceedings by rescinding most of the April 2022, November 2022, and April 2024 amendments to its procedures for supervisory designation proceedings. The amendments being rescinded allowed, among other things, public release of the CFPB's final determination on whether to designate an entity for supervision and had the CFPB's director make the determination on whether an entity should be designated without having a subordinate agency official first analyze the issue and make a recommendation. Under the version of the rule, which will be in effect going forward, information related to the proceedings will not be publicly disclosed and is considered confidential supervisory information. Lastly, Ballard Spahr reports that, quote, saying the federal government shutdown makes it impossible for them to work on the case, Justice Department attorneys are asking a federal appeals court to delay its response to a request for an en banc hearing in a lawsuit challenging mass firings at the CFPB, end quote. For today's interview, I'm pleased to be joined by Adam Potafiy, account executive at Finance of America. He's gearing up to take the stage at NAMB National with his colleagues Jonathan and Jessica for a session on reverse mortgages and how they're being reengineered for the next generation of clients. What can listeners expect from your session at NAMB tomorrow?
Our session is called Reverse Reengineered, Strategies for the Next Generation of Clients. And what's unique is that it's designed specifically for forward originators who don't currently offer reverse. We know you're experts in purchase and refi, so we're meeting you there and showing you how to translate your skill set to serve homeowners in or near retirement. And we'll also walk through misconceptions that stop so many brokers in their tracks from considering reverse, how to explain it in plain forward mortgage language, and then make it real with actual client stories. Those stories are always the eye-opener. Hearing how a late life divorced client or an affluent retiree or even someone downsizing was able to use reverse as a tool to reach their goals. And here's the kicker. It's not theory. By the end of this session, you'll have a simple checklist and a 30-day path you can use to originate your first reverse loan. And that's something you don't want to just hear about in a recap later. You want to be there in the room, asking questions and walking away with things you're ready to act upon.
And it probably begs the question, why is this topic so timely right now?
Yeah, it does. And let me say it this way. There are two major forces colliding. First, demographics. 2025 is the absolute peak 65 year. More than 11,000 Americans are turning 65 every single day. That's over 4 trillion people this year alone. And many of those people are in your past client databases. And second, home equity. Homeowners over 62 hold nearly 14 trillion in housing wealth. Think about that. $14 trillion sitting on the sidelines while those same homeowners are worried about cash flow, healthcare costs, or even just staying in their home comfortably in retirement. Meanwhile, on the originator side, the purchase and refi volumes are down. Depending on your first or depending on first time home buyer business alone is risky. Reverse is not a new product. It's a diversification strategy that helps you stabilize your pipeline in any market. That's why this moment matters. You can either sit out and watch your competitors add reverse, or you can be there at NAMB and get the playbook firsthand. That's the choice.
Well, for brokers out there listening, how do you explain reverse in terms that they already know and understand?
Yeah. I tell forward originators to think of it like this: payment optional HELOC for later life. So, payment optional HELOC for later life. Here's the comparison with a HELOC. You've got mandatory monthly payments, you've got interest rate resets, and even the risk of credit line being frozen. Cash out refi means taking on new debt, higher DTI, or likely giving up on low first rate mortgage, which is in today's rate environment is almost never attractive. But reverse is different. It gives eligible borrowers access to their equity without required monthly payment of principal or interest. They keep the title in their home. They have the option for how to draw the funds, and there's a non-recourse protection in play that ensures that they or their heirs never owe more against the home than it's worth. That's why I like the phrase payment optional access to home equity. When you use that language, forward originators immediately get it, and clients do too. Now, of course, borrowers must meet all loan obligations, including living in the home as their primary residence, and then paying the property charges, taxes, insurance, maintaining the home.
What's the main takeaway that you hope attendees will walk away with?
I think the main takeaway is this, Robbie. Reverse is no longer niche. It's mainstream. And you don't have to be in the reverse and you don't have to be a reverse mortgage expert on day one. You just need to know how to start a conversation and lean on the right partner. And that's where we come in. At Finance America, we've built tools like our reverse mortgage match that can at Finance America, we've built tools like our reverse match program that help you scan your past clients list and identify potential eligible borrowers in literally minutes. We also provide trainings, of course, marketing resources, even help you with a script for first-time conversations. You bring us the client scenario, and we'll walk with you step by step. For brokers, literally, this means you could go from zero to closing your first reverse in a matter of weeks. That's a game changer. And that's why missing the live session at NAMB means missing a chance to jump ahead of the competition. But if you absolutely can't be there in person, a good way to keep learning is by following us on the LinkedIn, Finance of America. We're constantly sharing updates, client education, and strategies you can use today.
Definitely some good insights there. Before I let you go today, though, any kind of final word for those thinking about attending your session?
Yeah, I do have. If you're serious about diversifying your business and becoming a lender for life, this is the session you don't want to miss. We'll break it down, answer questions in real time, and send you out with tools you can use right away. So join us at NAMB National for Reverse Reengineered. And again, if you can't be there in person, make sure to connect with Finance of America on LinkedIn. It's one of the best ways we can stay up to date on reverse opportunities, educations, and what's next in the market. Robbie, thanks again for having me. Really appreciate the chance to share this preview.
Yeah, and I appreciate you coming on and bringing some really good insights. I wish you the best of luck in your session, and hopefully we'll have you back on the podcast soon. So thank you.
Thank you.
And before you think you're going to hear a bell, I actually have a bonus interview for you today with attorney Brian Levy about the latest in the RESPA realm. Enjoy.
There have been several lawsuits against United Wholesale Mortgage. Recently, the Ohio Attorney General accused the company of deceptive practices. There were some misleading promises thing. There have been sexual misconduct lawsuits. There's a free speech lawsuit from Speech First Inc. There's a COVID-19 refund lawsuit. Several of these. UWM has had some great success in the courts recently. Maybe let's start there with what the latest is with all these lawsuits and how UWM seems to be having the last word at the end of the day.
Yeah, I don't really know much about all of their lawsuits, Robbie. I do follow the lawsuits that have RESPA allegations. And the one that you started with the Ohio Attorney General, that one looked very similar to the one that was brought by the Boyce Schiller law firm a couple of years ago, where they made all kinds of RICO violation allegations, unfair, deceptive kinds of claims, and then sort of threw in RESPA as an afterthought, really.
RICO claims were dismissed.
RICO claims were dismissed. Most of the unfair, deceptive claims were also dismissed. What was left was the RESPA claim. And I again, wrote about that. And I think that actually those claims are significant, things that the industry needs to consider in light of, the possibilities that could jeopardize how wholesale lending is currently done.
So where does what is still out there against UWM? Have they completely cleared the minefield here, or what's on the horizon for them?
Well, what the court found in this decision, first of all, let me be clear. This stage of the litigation is what's known as a motion to dismiss, the failure to state a claim. So they won on the RICO, they won on the unfair, deceptive for the most part. And what that means is taking everything that the plaintiffs say as true, just assuming that it's true. We haven't proven it at this stage of the case. We're just assuming everything is true. You still haven't made a claim of a violation of law. Like whatever you allege doesn't amount to a violation of law. The only one that they said might amount to a violation of law is the RESPA claims. And again, there's some state law claims in Florida that were sort of derivative of the RESPA claims. But the issue is very interesting in light of how wholesale lending is currently done today. And the argument is that, and frankly, it was inartfully pled and inartfully described by the court, I think. But basically, wholesale lenders give their brokers a lot of other things other than just a broker fee. They give them compliance guidance and they give them marketing assistance, various other things that are potentially things of value beyond just the broker fee. And that's what the court said, well, you've alleged enough here to allege a RESPA violation, that you're giving things of value in return for referrals above and beyond what you're entitled to as a broker fee.
What evidence would the plaintiffs need to present to prove UWM violated RESPA, whether it's records, emails, transactions, witness testimony? And conversely, what defenses do you see UWM employing in the case?
I would start with the defense position, which is that in 2000, HUD, in 1999, HUD issued a policy statement that clarified under RESPA that as long as you take an application and provide 5 out of 12 services, that you can be paid a reasonable broker fee under RESPA, under Section 8A, and not violate RESPA. Okay, so that it wasn't just a payment for the referral of a loan, it was payment for these services. Recently, the Supreme Court sort of limited the applicability of regulatory guidance and put that back in the role of the court to decide whether something is to interpret a statute like RESPA. Although the CFPB did have express authority to interpret RESPA. And this policy statement was done by HUD. CFPB adopted it later. That was as close as they came to saying anything about the nature of broker fees under RESPA. But the evidence that the plaintiffs are likely to bring will be all these other goodies that UWM supposedly provides to their brokers in addition to a broker fee, trips to Detroit, things like the marketing guides. I don't know if it's UWM or Matt Ishbia as owner of the Suns, just renamed the Suns Arena for one of UWM's marketing efforts, which is designed to attract consumers and then give consumers to brokers who then will use UWM for their loans.
What are the larger industry implications, both for this case or in generally speaking, when there's a RESPA case, is it limited to that financial institution, or is it have further rippling effects for the overall industry in the way that regulations are interpreted or
First of all, most cases settle. Okay. And if this one settles, there's no law that's been made. If UWM were to lose on this case, and it would implicate the practices of other industry participants who do similar things, there might be claims brought against those other institutions, or the case might be appealed. And it goes through the appeals process. And we've seen that in other issues with Townstone and fair lending. And so you kind of have to follow it all the way through to see what law is actually made or what interpretation of law is actually made that's applicable to the industry. We're a long way from that. But it's certainly a case that I'm going to keep my eye on and see what happens.
Are there any other recent rulings, cases, or guidance that you could see influencing how they interpret the RESPA claims in this case specifically?
There's been some interesting developments in the affiliated business area, some interesting, just to put it mildly, interpretations of proper capitalization for affiliated business arrangements that has been made by some enforcement authorities, attorneys general, in various consent orders. But I don't think there's a lot of guidance around broker fee compliance with RESPA in the courts that I've seen. The only thing was the HUD guidance that was adopted by CFPB.
Help me. This is me off the record. Help me help you. What is the question I'm not asking I'm supposed to ask about this or the UW?
This might be a boring interview, but for lenders, what if a broker fee is really a RESPA violation? What if the whole concept of wholesale is really just premised on paying somebody for the referral of a loan? Realtors have the ability to do that. They can refer a real estate transaction to another realtor and just pay a referral fee. There's an express exemption under RESPA. In fact, title insurance companies have a similar exception. But mortgage lenders don't. Mortgage lenders at the time RESPA was enacted in 1974 were not licensed. There was banks, they were regulated, but most states did not have licensing of mortgage brokers back then. Now we have NMLS. Every mortgage broker has to be licensed with some state. And so we have a fully regulated industry that just basically wants to pay referral fees to each other for originating loans. And we have this law that says, well, you can't pay referral fees. So you have to figure out another reason why you're paying that. So the reason is you're paying for services, but it's kind of silly because you're not paying for services on loans that don't get delivered to you. So really, the only time you get paid for those services is when you deliver the loan.
You mentioned RESPA was written in 1974. Has it kept up over its half century plus of existence? Where does it need updating? Where does it still do a good job?
We don't have enough time to discuss all of the ways in which RESPA has not kept up, but certainly it was designed with a pre-internet, pre-AI, all the technology that we have today to deliver to consumers information, none of that existed. And so the idea that, paying a middleman something was somehow raising costs for consumers, empirically is questionable today.
Where does it need to adapt to meet modern AI and technology happenings?
The NBA did a report last year called RESPA at 50. I helped them with that. There was a lot of people that worked on it. It's a very detailed report. It was submitted to the CFPB. This was all pre-Trump administration. RESPA is a very simple concept if you think about it. You can't pay a referral fee for settlement services. How it gets played out and how it actually impacts consumer protection is very complicated today. And I think it sort of boils down to conflicts of interest and trust in the transaction. The idea that your trusted advisor and your realtor or somebody might be getting a handout from somebody else in the transaction somehow makes people feel queasy, and maybe it should, but maybe it shouldn't. If it's just a internet referral for a click, pay fee for a click, maybe it doesn't bother people that much. So those nuances are completely ignored in RESPA from 1974. And I think modernizing it would be very challenging because you have to figure out, well, what is your goal? What are you trying to accomplish with this law today? And is that even needed?
Any other notes about UWM before we conclude this interview? They seem to be holding up incredibly well in the judicial system.
Well, I mean, I think you're overstating the case because I think, again, these RESPA issues are serious. And I don't know how well they're doing in other cases. The Ohio case has not yet been decided. This case involving RICO and unfair deceptive, I think was probably overstated to begin with. It was a novel application of RICO to what is sort of a standard transaction in American commerce. So I think it was an awkward use of RICO, which is really designed to get at organized crime, to get at a consumer protection issue. But RESPA's consumer protection. So we'll see where that ends up.
Well put. Thank you very much for the time.
All right.
The longer the government shutdown lasts, the more impact it will have on overall economic output and GDP. When the government shutdown does end, there's only so much ground that can be made up, especially as many private sector businesses that rely on government spending begin to feel the strain. Yesterday, the bond market finally showed a willingness to push below the 4% level on U.S. 10-year treasuries, signaling the break of a key psychological support point and amplifying the risk-off sentiment among investors. Treasuries are also considered a safe haven when stocks begin to underperform, which could bring down rates. Meanwhile, banks are back in the spotlight, raising broader concerns about credit quality in the economy after notable charge-offs and stock drops tied to questionable lending. Freddie Mac reported mortgage rates on its primary mortgage market survey slipped for the second straight week. That's good news, falling back toward year-to-date lows. Today's economic calendar should have consisted of import-export prices for September, housing starts and permits for September, and industrial production and capacity utilization for September. However, due to the government shutdown, none of these will be reported. Speaking of which, the bill to reopen the government failed for the 10th time in the Senate. Markets will also receive remarks from St. Louis Fed President Muslim, the last public remarks until after the FOMC's monetary policy meeting over October 28th to 29th. We begin Friday with agency MBS prices unchanged from Thursday's close, but gradually improving over the week. The 2-year yielding 3.43 and the 10-year yielding 3.98 after closing yesterday at 3.98%. Let's wrap up with a joke and some housekeeping. I mean, it's spooky season, so here's a spooky joke. A girl ran up to me at the cemetery and said, "I need to pass through the cemetery, but I'm scared to walk alone. Can you walk with me across?" I replied, "Oh yeah, of course. Don't worry, I used to be super scared of cemeteries when I was alive too." Thanks again to today's podcast sponsor, Flowify. With its new dynamic AI feature, Flowify delivers smarter, faster digital mortgage experiences that lenders can tailor to each loan type. Learn how to reduce friction, boost compliance, and close loans with more confidence at flowify.com or visit Flowify at MBA Annual. And don't miss them at the Tech Showcase at the Fountain Blue on Monday, October 20th at 3:25 in the afternoon.